Right, this is a recording to go over the closing procedure, just as a review. So there are two reasons why revenue and expense ledgers are closed off the reporting period. One is so the net profit or loss can be determined in the ledgers before reports are prepared. And then when the reports are prepared, you can compare them to see that you've got the same figure for your profit. And of course, to zero off your revenues and expenses so that they are ready to record the new transactions for the next reporting period. So there are 4 steps to the procedure. Closing off revenue accounts as a group, right, to the profit and loss summary account, closing off expenses as a group to the profit and loss summary account, and then transferring the profit or loss to the capital account and to close off the drawings. So here is some typical looking ledgers that we have revenues, and of course we have our sales returns, which is a negative revenue. So you close them off, the revenues, by debiting the accounts and of course crediting the sales revenue. And so we end up with a credit of net revenues of 9720. So you'll notice that these credits here are still on the credit side, of course, with the subtraction of the sales returns. They've just been transferred or closed to the profit and loss summary as a group. So remember, we're just writing the cross-reference revenues because we're just transferring, reducing them all down to one figure. And likewise, same with the expenses. So here are some typical looking expenses here on the debit, and we'll close them by crediting them. And there is that debit, the total amount of the expenses still on the debit side, 7,800. We've just transferred it to the profit and loss summary. We've reduced them all down to one figure. And of course, the cross-reference will be expenses. And then of course, the difference between the two, right? Revenues are greater than expenses. So we've made a profit. We don't write profit, we write capital. The profit belongs to the owner. And so if we have a look here, is the typical looking general journal entries. Here's step 1, transferring the revenues, including the sales returns. Here are the expenses. The expenses are credited and then one debit. And you can see here the difference between the two. You can work out that there's a profit. So here is the transfer entry in the general journal to capital. Remember, if you made a profit, you will credit capital because profit will increase capital. So that would be a credit. And there's that debit we saw earlier in the profit and loss summary account. And then the last step is to close off the drawings. And so here are those ledgers. There is the balance at the beginning that we have. There is that transfer of the profit, 1920, so increasing your capital. And here is the transfer of the drawings to the capital ledger. So remember, drawings will be a debit, and to close it off, you have to credit it, and then it's still going to be a debit. So the drawings is still a debit, but it's been transferred to the capital account. And then, of course, you'll balance it. And so you can see here this business has increased its capital from 9,720 to 11,040. And this is the figure that will go in the balance sheet. And of course, you will, in your owner's equity section, indicate all of that information. And so the ledgers are now finished, closed off for the period, ready to start the next period. Thank you.